Welcome back to Market on Close. I'm Sam Bartis, live from the floor of the New York Stock Exchange. It's time now for Overlooked Stocks. I'm joined by George Tsilis, as always, Senior Markets Correspondent, for a look at SERV Robotics, which is falling over 10% today in trade. What's the reason behind that one, George?
Well, I think obviously the reason today that the stock is down, Sam, is in sympathy with the markets. Considering this is certainly a growth story for SERV Robotics, and it's a high beta name in the marketplace. But this week it's actually been a good week for the business overall and for the stock, irrespective of today's move to the downside. But one of the things about the business itself is they're growing quite substantially, and they're one of the pioneers in autonomous robotics. This company was also coincidentally spun off from Uber not too long ago, and they developed self-delivery robots that are primarily designed for food delivery, last-mile parcel delivery, as well as being equipped with artificial intelligence. And they're becoming more ubiquitous, especially in urban centers where there's a lot of pedestrian traffic. And again, this is for delivery of food primarily in small parcels on sidewalks where there's pedestrian traffic. And recently, they actually launched their 1,000th unit, so they're actually deploying 1,000 units in total as of last month, and they're expected to deploy double that amount by the end of this year. And they've been growing quite considerably. And this last week, there was a positive catalyst for the underlying business as they partnered up not only with Uber Eats, but now they've got a new partner in DoorDash for their robotics delivery technologies. And with that said, the stock actually jumped as a result of that news. And also, if you look at some of the other aspects of the business, Wedbush denoted a higher price target from $15 to $22, maintaining an outperform rating. There was one other news headline, too, with the stock trading yesterday at about $1 billion in market cap. Because of the previous day's move, the stock, or the company now, did issue about $100 million in secondary offerings to shore up their balance sheet, provide cash and liquidity to expand their business. And that also might be some of the reasons we're seeing in sympathy with the overall market, why the stock is down today, putting under pressure, because about 10% market cap was essentially issued in secondary offerings, so that's certainly going to put some pressure on the shares.
Okay, understood. I mean, yeah, these food delivery robots have become all the rage. I mean, they're very popular over in New Jersey, Jersey City, where I am, and quite a hit with my toddler as well. We also had the CEO on the show last month to discuss Voice's integration and level 4 autonomy. So what's the sort of long-term business plan for the technology right now, George?
Well, I think the business plan is pretty solid in terms of the prospects and growth, in terms of, again, more concentrated urban delivery for these robots. We know that robotics has been a tremendous theme this last year. It's probably just going to continue going forward. Right now, SERV, competes with other technology companies in the space. Amazon is the primary publicly traded one. There's a couple of other private ones, Starship Technologies and KiwiBot, forgive me, which is another privately held company. But nonetheless, if you look at the sales last year for the business, it was around $1.5 million, which isn't too much considering the $1 billion market cap. The estimates this year now are around $4 million. But if you fast forward to next year, there's actually a pretty tremendous growth estimates up to $36 million. So we're talking nearly tenfold increase in sales by next year. So they're rapidly deploying their technologies. Obviously, they're going to be integrating it from an autonomous standpoint with artificial intelligence. But I do see the case point for these technologies and the market share growth that SERV prospectively can have, considering they're one of the leaders so far. But you also have to consider some of the risks, which right now are market-based risks, high beta risks, as well as the fact that they're still, irrespective of the revenue growth that I mentioned, for next year, are still not expected to achieve any form of profit next year either.
Okay, thanks so much for that, George. A good look at the robotic space today, but under pressure as we look at this broadly lower market.